Hey traders! Welcome back to the ComLucro channel. Today, we're diving deeper into the technical analysis for day traders course, covering one of the most essential tools, continuation chart patterns. In our last video, we covered reversal chart patterns like the head and shoulders and double tops, which signal potential trend reversals and help traders identify when a trend is losing strength and may be about to change direction. Now that you're familiar with spotting when trends might reverse, it's equally important to understand when they're likely to continue. In this video, we'll shift focus to continuation chart patterns, which play a key role in confirming that a current trend is likely to persist. These patterns help traders identify when a brief consolidation is merely a pause in the trend, offering key opportunities to jump into the market before it resumes its direction. We'll begin by discussing what chart patterns are and how they illustrate the constant push and pull between buyers and sellers in the market. From there, we'll dive into some of the most reliable continuation patterns, specifically the flag, pennant, rectangle, ascending triangle, and descending triangle. Each of these patterns signals the likelihood of a current trend continuing, and recognizing them in real time can give you a significant advantage in your trades. But why are continuation patterns so important? Simply put, they confirm the strength of the current trend. Whether in an uptrend or downtrend, these patterns suggest that the market is taking a brief pause before continuing in its previous direction. Properly timing these moves can dramatically improve your trading performance by keeping you on the right side of the trend. To bring this concept into focus, let's hear from Larry Williams, who explains how periods of low volatility can set the stage for explosive trend moves, the ideal conditions for continuation patterns.
Day traders think they can make money every single day. They can't. Some days are much better to have a big trend move than others. So how do you know when you're going to have a large trend move? Because that's the only way that a short-term trader will make money. So when do those days occur? I'll tell you when. When we've had a series of 1 or 2 days with small ranges, then we're going to have large ranges because the markets move in a natural cycle, small ranges to large ranges. So when I'm day trading, I sit back, I wait until I've seen a series of small ranges, because then I know I'm going to have a large range, an explosive range. Large ranges don't attract me to day trading. They do most day traders, and they end up losing because then we go into small ranges. To be a successful day trader, use patience, wait until you see small ranges, because that's when your best opportunities are going to come.
With that in mind, let's now explore how to spot and trade key continuation patterns that often follow these moments of market contraction. Before we dive in, it's important to clarify the objective of this chapter. We're going to explore continuation chart patterns, their key characteristics, how they confirm the persistence of an existing trend, and how you can effectively incorporate them into your trading strategy. In the previous video, we discussed reversal patterns, but today we'll focus exclusively on continuation patterns, which signal that a trend is likely to resume after a brief pause. For this video, we'll be using examples from real market charts to show how continuation patterns appear in practice. We'll be using TradingView as an example platform due to its popularity and accessibility. Keep in mind that while continuation patterns themselves are universal, different platforms might display price data or pattern drawing tools slightly differently. It's crucial to be familiar with your platform's features to accurately identify and confirm these patterns, ensuring you interpret the signals correctly for effective trading decisions. Now, let's begin by answering the question, what are continuation chart patterns? Continuation patterns are formations on price charts that indicate a temporary pause in the current trend, suggesting that the trend is likely to resume afterward. These patterns are particularly valuable for day traders, as they help confirm that an existing trend, whether up or down, still has momentum and is likely to continue after a brief consolidation. The main goal of continuation patterns is to give traders confidence that the current trend will persist, allowing them to position themselves to ride the trend further. By recognizing these patterns early, traders can avoid prematurely exiting trades or missing opportunities to enter positions aligned with the prevailing trend. At their core, these patterns reflect a temporary consolidation or pause in the ongoing trend, rather than a reversal in market sentiment. For example, in an uptrend, continuation patterns suggest that buyers are taking a short break to consolidate gains before resuming their push higher. Conversely, in a downtrend, they indicate that sellers are briefly pausing before continuing to drive prices lower. These pauses often present opportunities to enter trades aligned with the dominant trend, allowing traders to capitalize on the continued momentum once the consolidation phase ends. Let's explore the bull flag and bear flag patterns. These patterns typically form during strong trends and signal a brief pause before the trend resumes in the same direction. A bull flag forms during an uptrend, indicating a temporary consolidation before the upward movement continues. It features a sharp price rise, the flagpole, followed by a consolidation phase where the price moves within a downward sloping channel, the flag. A breakout above this channel confirms the continuation of the uptrend. In contrast, a bear flag occurs in a downtrend, where the price consolidates within an upward sloping channel before breaking down, signaling the continuation of the bearish movement. To spot a flag, look for a strong price movement followed by a consolidation phase. The breakout from this consolidation confirms the continuation of the trend. The breakout is crucial as it marks the point where buyers regain control in a bull flag or sellers in a bear flag, signaling the end of the consolidation and the resumption of the original trend. As you can see on the Bitcoin against the US dollar chart, the market is in a strong uptrend and begins forming a bull flag pattern. First, notice the sharp rise in price, forming the flagpole, a rapid upward movement fueled by strong buying momentum. After this rise, the market enters a consolidation phase, where the price moves within a downward sloping channel, forming the flag. During this period, the price remains confined within a narrow range, reflecting a temporary balance between buyers and sellers. However, this phase is merely a pause in the trend, and it's essential to watch for the breakout. Now, as the price approaches the upper boundary of the flag, watch closely. Once it breaks through this resistance, we have clear confirmation of the bull flag pattern, signaling the continuation of the uptrend. Traders often use this moment to enter positions, taking advantage of the resumed upward momentum. Similarly, with a bear flag, the market experiences a sharp drop in price, forming the flagpole during a downtrend. Following this decline, the price consolidates in an upward sloping channel, indicating a brief retracement. As the market gathers momentum, it's crucial to monitor the lower boundary of the flag. When the price breaks below this support, we have confirmation of the bear flag, signaling the continuation of the downtrend. Traders can use this as an opportunity to enter short positions, expecting further declines. Let's now explore the pennant, another important continuation pattern in trading. The pennant forms during strong trends and signals a brief pause before the trend resumes in its original direction. It resembles the flag, but differs in that the price consolidates into a small symmetrical triangle rather than a sloping channel. The pennant represents a temporary indecision in the market before the continuation of the prior move. In the case of a bull pennant, the formation occurs after an upward price movement. First, there is a sharp price increase, creating the flagpole. Then the price enters a consolidation phase where the highs and lows converge, forming the triangle. A breakout above this triangle confirms the continuation of the uptrend. For a bear pennant, the same principle applies, but in a downtrend. After a sharp drop, the price consolidates into a triangle before breaking downward to resume the bearish movement. To identify a pennant, look for a strong directional move followed by a triangular consolidation. The breakout from this consolidation confirms the continuation of the trend. The breakout is crucial as it marks the point where buyers regain control in a bull pennant or sellers dominate in a bear pennant, signaling the end of the consolidation and the resumption of the trend. Now, as seen on the Bitcoin against the US dollar chart, the market is in a strong uptrend and begins forming a bull pennant. First, there's a sharp upward movement, creating the flagpole. Then, the price consolidates into a triangle as the highs and lows converge. During this phase, the market reaches equilibrium between buyers and sellers, but this pause is only temporary. Watch as the price approaches the upper boundary of the triangle. Once it breaks through this resistance, we have confirmation of the bull pennant, signaling the continuation of the uptrend. Traders often enter positions at this point, taking advantage of the resumed upward momentum. Similarly, in a bear pennant, the market experiences a sharp decline, forming the flagpole. After this drop, the price consolidates into a symmetrical triangle. When the price breaks below the support line at the triangle's base, the bear pennant is confirmed, signaling the continuation of the downtrend and offering short selling opportunities. Let's now dive into the rectangle continuation pattern. The rectangle pattern forms when the price consolidates between two horizontal levels of support and resistance. Unlike the flag or pennant, which have sloping channels or triangles, the rectangle shows a period where the price moves sideways in a clear range before breaking out in the direction of the prior trend. It's a straightforward, yet effective pattern that signals the continuation of the existing trend, either bullish or bearish. In a bullish rectangle, the pattern appears after an upward move. The price oscillates between a horizontal resistance at the top and a horizontal support at the bottom, forming a rectangular shape. The breakout above the resistance signals that the uptrend is likely to resume. Conversely, a bearish rectangle forms after a downward move, with the price consolidating between horizontal support and resistance levels. A breakout below the support confirms the continuation of the downtrend. To spot a rectangle, look for a trend, followed by a consolidation phase where the price moves sideways within a defined range. The breakout, whether upward in a bullish rectangle or downward in a bearish rectangle, confirms the continuation of the trend. The breakout is critical, as it shows when the market has decided its direction after the period of consolidation. In a bullish rectangle, buyers regain control once the price breaks above resistance, while in a bearish rectangle, sellers dominate when the price breaks below support. Now, let's add an example of the bullish rectangle on the Bitcoin against the US dollar chart. The market is in a strong uptrend before entering a bullish rectangle. After a sharp upward move, the price consolidates between a resistance level at the top and a support level at the bottom, forming a clear rectangle. During this phase, the price fluctuates within this range, showing indecision between buyers and sellers. However, this sideways movement is only temporary. As the price approaches the upper boundary of the rectangle, watch carefully. Once it breaks through this resistance level, the bullish rectangle is confirmed, signaling that the uptrend is likely to continue. Traders often look for these breakout points to enter long positions and capitalize on the continuation of the bullish trend. Similarly, in a bearish rectangle, after a significant downward move, the price consolidates within a horizontal range. When the price breaks below the support level, the bearish rectangle is confirmed, signaling a continuation of the downtrend and offering an opportunity for traders to enter short positions. Let's explore the ascending triangle and its counterpart, the descending triangle. These two patterns form during trends and indicate the potential continuation of the current direction after a period of consolidation. The ascending triangle is considered bullish, while the descending triangle is typically a bearish continuation pattern. In a bullish ascending triangle, the price forms a series of higher lows, while the highs hit a flat resistance level. This creates a triangle shape as the rising trend line converges with the horizontal resistance. The pattern indicates that buying pressure is increasing as the market keeps pushing higher, leading to an eventual breakout above the resistance line. In contrast, a bearish descending triangle forms during a downtrend. In this case, the price creates lower highs, but the lows hit a flat support level. The descending trend line shows growing selling pressure, and once the price breaks below the support level, it confirms the continuation of the downtrend. To identify these patterns, keep an eye out for the following. In an ascending triangle, look for rising lows paired with a flat resistance level at the top. For the descending triangle, watch for lower highs with a flat support line at the bottom. The breakout is key in both patterns. In the ascending triangle, buyers eventually overpower the resistance, signaling the continuation of the uptrend. In the descending triangle, sellers break through the support, confirming the continuation of the downtrend. Now let's add an example of the bullish ascending triangle on the Bitcoin against the US dollar chart. The market is in an uptrend and begins consolidating. The price forms higher lows, but each rally meets resistance at a horizontal level, forming the ascending triangle. As the price consolidates and gets closer to the breakout point, buyers keep gaining strength. When the price breaks through the resistance, the pattern is confirmed, signaling the continuation of the uptrend. Similarly, in a bearish descending triangle, the price is in a downtrend and begins consolidating. It forms lower highs, but the lows find support at a flat level. As selling pressure increases, the price eventually breaks below the support level, confirming the descending triangle and signaling the continuation of the downtrend. Now, let's discuss the benefits and risks of using continuation chart patterns in your trading strategy. On the benefit side, one of the key advantages is that continuation patterns help confirm that a trend is still strong, allowing you to stay in profitable positions longer. These patterns reflect real market consolidations and provide a clear, objective view of ongoing momentum, helping traders make informed decisions based on actual price action rather than emotions or guesswork. Another benefit is that continuation patterns make it easier to identify key moments where the trend is likely to resume. Whether it's a flag, pennant, or triangle, these patterns show when the market is taking a temporary pause before continuing in the same direction. This is especially useful in day trading, where timing is critical. By recognizing continuation patterns early, traders can confidently enter or add to positions, improving their timing and maximizing gains. Moreover, these patterns provide clear entry and exit points. Once a pattern like a bull flag or symmetrical triangle is confirmed, traders can execute their trades knowing the trend is likely to persist. This structured approach helps traders avoid impulsive decisions and stick to a rules-based strategy. However, there are also risks involved in using continuation patterns. One significant risk is the potential for false breakouts. Even when a pattern appears to be forming correctly, the market can sometimes reverse unexpectedly, leading to a false breakout. This is especially common in volatile markets, where price fluctuations can mislead traders into thinking the trend will continue when it doesn't. Another risk is that continuation patterns don't account for external market factors, such as unexpected news events or economic data releases. A pattern might look strong on the chart, but sudden external factors can disrupt the expected breakout or continuation. Additionally, some continuation patterns may take time to confirm. This delay could result in missing part of the move or jumping into a trade too late when much of the potential profit has already been realized. It's also important to avoid overconfidence. Just because a trader has been successful with continuation patterns doesn't mean they will work in every scenario. Market conditions change, and relying solely on these patterns can lead to losses if broader market factors such as overall trends or key support and resistance levels are ignored. In summary, while continuation chart patterns are powerful tools for confirming ongoing trends, traders should always be aware of their limitations. Combining these patterns with other forms of analysis, such as volume indicators or broader market context, will lead to more reliable and effective trading decisions. Now let's talk about some of the most common mistakes traders make when using continuation chart patterns, and more importantly, how to avoid them. First of all, one frequent mistake is relying only on chart patterns without considering other important factors. Yes, patterns like the flag or triangle can provide great insights, but they're not foolproof. A pattern may look ideal, but if you're ignoring the bigger picture, things like economic events, overall market sentiment, or volume trends, you might end up misreading the signals. So it's always a good idea to confirm continuation patterns with other analysis tools such as volume confirmation or checking higher time frame trends to give yourself a stronger signal. Another common mistake is jumping into trades too early before the pattern is fully confirmed. For instance, entering a position before a bull flag breaks above its resistance level or before a pennant has confirmed its breakout can lead to premature trades and potential losses. Patience is really key here. Waiting for a clear breakout or proper confirmation before committing to a position can save you from unnecessary risks. Now, it's also easy to fall into the trap of over-anticipating patterns. Just because the market starts showing signs of a flag or triangle doesn't necessarily mean the pattern will complete. For example, an early bull pennant might turn into a longer consolidation phase or even fail. So the best practice is to wait until the pattern fully forms and confirms before making any trading decisions. To avoid these common mistakes, let's go over a few best practices. First, always use confirmation signals. Whether it's volume, trend lines, or even momentum indicators, these can help you reduce the chances of falling for false breakouts. Second, stay aware of the overall market environment. If a pattern forms during a period of high volatility or in response to major news, be cautious, as the continuation might not unfold as expected. And finally, stick to your trading plan. Make sure you've set your entry, stop loss, and target levels based on the full confirmation of the pattern. Don't rush in too early. Patience often pays off in the long run. By keeping these tips in mind and using continuation chart patterns thoughtfully alongside a broader market analysis, you'll be able to make better trading decisions and improve your overall strategy. In conclusion, we've covered some of the most essential continuation chart patterns that every trader should be familiar with. Patterns like the flag, pennant, rectangle, and various triangles provide valuable insights into the strength of ongoing trends, helping you stay ahead of market movements. Mastering these patterns allows you to better anticipate when a trend is likely to continue, improving your timing for entering and exiting trades. This is a good moment to hear from Tom Hougaard, who brings a realistic perspective on how trading strategies, even when logical on paper, can behave differently in live markets.
So it's not such a long stretch for us when we get engaged with technical analysis that we begin to connect one high with a secondary high and a third high, and we extrapolate a line out in the future, and we call that a trend line. And when a trend line has been broken, we get a signal. And it's a thing of beauty because, hey, it looks so easy when we are sitting doing our research. But the deception of charts, what we call apophenia, is playing a trick with us, meaning that we will gladly omit this trend line break. Yet when we are trading it in real time, all of a sudden we are seeing this trend line break. And so we are surprised when this happens, because during our research, it looked like this. There was a trend line break and the market stormed higher and we were on board, and now I'm trading it and it's not storming higher. In fact, it's trading lower and lower. In this case, you actually do get saved by the bell. But many a good strategies has been created on paper that are completely impossible to implement in real time.
His message is a strong reminder. No matter how clear a chart pattern looks during analysis, real-time trading requires emotional discipline, adaptability, and awareness of execution challenges. It's important to remember that these patterns are most effective when combined with other forms of analysis, such as volume confirmation or a broader look at market trends. Incorporating them into a well-rounded strategy will help you stay objective, avoid emotional decision-making, and boost your overall trading success. If you want to expand your knowledge, make sure to check out other videos in our playlist, Technical Analysis for Day Traders, from Basics to Advanced course. You'll find valuable insights in videos like reversal patterns, head and shoulders and double tops, how to use technical indicators, basic candlestick patterns, advanced continuation patterns, and much more. These will give you a more complete understanding of technical analysis and help sharpen your trading skills. Thank you for watching, and be sure to explore the rest of the course to continue growing as a trader.
I hope you enjoyed today's video. If you found the content useful or fun, please give it a like, as this helps the video reach more traders like you. Remember to subscribe to the channel and activate notifications to stay updated with the latest financial market information and trading tips. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Your support allows us to continue bringing high-quality content, helping you make more informed decisions in the markets. Thank you for watching, and good luck on achieving excellent results in your trades.